So welcome everyone, welcome back everyone. I'm very happy to be with you tonight. I am Pierre Verret, in-house market analyst at GMG Global Markets Group with you tonight. Throughout the last session, the last two sessions, we've been slowly getting introduced everyone to the world of trading, to the journey of trading. We learned how to use the MT5 platform. Throughout the last session, we put the emphasis on identifying and know how to use the different order types. And actually, I've had a few questions about that session as well. So tonight we're gonna start the first module of technical analysis. I remind you that this is a 7-part live webinar series with a session every 2 weeks. And tonight we will lock in the real foundation of technical analysis, and it's all going to be about identifying a trend, marking support resistance, marking your chart or your market, drawing clean trend lines, and using Fibonacci tools, which will be retracement and expansions to build a simple, repeatable trading plan. So before I move forward, let me clarify this a little bit of a disclaimer for you guys. This presentation is for information only and does not constitute advice. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 53.9% of retail investor accounts lose money when trading in CFDs with this provider, and you should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. CFDs are provided by Global Markets Group Limited on an execution-only basis, and we do not provide any advice, and any written or verbal communication with us should not be considered as such. All right. So now that we've been through this, so I was saying today's topic is it's going to be the first few steps in technical analysis. Okay, so first off, we're gonna start with identifying a trend. You're gonna see this is the easiest things to do. Mark your market or mark your charts, as I like to say, with a support and resistance. Understand how to pinpoint key support and resistance levels that influence price behavior and market psychology. Use trend line and identify your first chart pattern. So this one is going to be particularly important, especially for the upcoming session in 2 weeks now, because we're going to be using these tools to deep further, regarding chart pattern recognition. Okay, so I'm gonna stop the teasing now, and I'm gonna let you know more about this at the end of the session anyway. And then we're gonna start using the Fibonacci tools. So there's a bunch of Fibonacci tools. We're just gonna be using the most used one, and in my opinion, they are among the most reliable ones as well. So we're gonna explore Fibonacci retracement and expansion tools to forecast potential support, resistance, and price targets in trading setups, right? So now let's go. Oh, sorry. Let me remind you that if you have, we're gonna do a short Q&A at the end of the session. But if you have any questions, right, please feel free to use the chat panel, and I'll take the time to answer each and every one of you. All right. So let's start with the trend. So honestly, don't believe any, like, all those trading gurus or those so-called experts that are gonna make you pay to provide you with a customized indicator to select the trend. Forget about the scanners, forget about all those things. Of course, I don't have anything against scanners, right? Because they are time savers when you want to trade and when you want to pick a market to trade, right? But identifying a trend, I'm sorry, but this is the easiest thing to do in technical analysis. In one, if you look at the chart, the first glance you look at the chart, I mean, you get the idea of where the market is going. I'm going to tell you why it's so easy. Trend is the anchor, right? Without it, entries are like guesswork, more or less. We always begin, the idea is to always begin on the higher time frames, D1 or H4, for example, to have a broad vision of where the market is going. And you get a reliable context and everything. And then you want to step down to H1, M15, or M5 for execution, right? So now I'm gonna let you know, I'm gonna tell you right away why it is so easy to identify a trend. In an uptrend, we expect, so I'm gonna talk slowly, okay? Just mark my words. In an uptrend, we expect higher highs and higher lows. That's it. Okay. In a downtrend, on the other hand, we're gonna expect lower highs and lower lows. It's visual and it's very effective. That's about it. So now let me switch to the platform right here. Okay, so we have the charts of Euro USD right now. We have this big candle because we're in the middle of the FOMC decisions on rates, unfortunately. So there's a lot of volatility right here. Um, so basically, I told you an uptrend is higher highs and higher lows. Okay, let me mark my charts. Here, for example, you can see that the market is bullish, right? Because you have like, I mean, the market is trending higher. Waves, with waves, well, you can tell the price is moving higher. So this is symptomatic of a perfect bullish trend. And this is only the short-term move, okay? It only concerns this price swing. But you can do the same with, on a more long-term view. Like here, for example, I'm going to remove that one. Here, higher highs and higher lows. This is a bullish trend. End of the story. I mean, identifying a trend, it looks pretty easy, okay? But this is the first thing you want to know, because when you open a chart, let's say I just opened the chart of gold N15, I know the market is trending higher. If you know that the underlying trend of a market is bullish, for example, you may want to buy some dips, or look to buy the market, for example. That's an example of a strategy. You can always sell short of a bullish market if you play retracement moves. Of course, this is still doable, but honestly, knowing the underlying trend, like long term, short term, mid term, it already gives you a lot of informations, right? So now let's move forward. Mark support and resistance zones. So this one is crucial, right? I always say mark your chart or mark your markets. It helps you having a sort of a roadmap for your trades. So let me take an example right now. So let's take the basic definition of support and resistance. Okay, so let me remove those arrows, right? Let's go back to this chart. Okay, so resistance level are above price. Okay, our technical levels are recognized by the markets, capping the price basically. Support level, as it says in the name, are here to support the market. Okay, every time the market touches or reaches that level, you can expect a bounce back or something like this. Okay, this is why we call it support levels. You need to train your eye a little bit to identify clever supports and resistance zones, but still it comes naturally, right? Support and resistance zones, we're not going to talk about a line. They are kind of areas where price reached multiple times, and they derive from swing high lows, and basically round numbers. For example, like on gold, 118, 120, things like this. Okay, so you may want to use the highs and lows and round numbers. You want to keep it simple, right? Don't place too much support and resistance on your charts. Basically, try to keep it under 5. I would say 3 to 5 are good enough already for to build a solid trading plan. So here, for example, what do we have? We had this one right here, okay, recognized by the markets. This is a resistance level. So resistance are always in red on my charts. Support levels are always in green. This one, of course, and we had this one. And we are currently registering a breakout thanks to the FOMC's decision on rates. Right. So now, support. I'm going to remove that one. Let's pretend that we are here. Okay. So now the market recognized this is the last stop. from the market. The market is now going down because, I mean, we had a huge bullish price swing, as you can see here, and now the market is up for a correction, okay? So now you may want to know, this one is a support area. Let me put it in green. So now you may want to know, once we're here, you may want to know where the market can, bounce back, because you're in a bullish trend, right? You got high highs and higher lows. The first support that you have is this one. And actually, it's more like a zone. Let's go with shapes rectangle. Look, I like to base my support and resistance levels on, closing prices, but I also take into consideration the wicks of the candlesticks right here. So that's why you can draw like a sort of a line. I've taken, as you can see in this box, the wick here. Oh, we don't see it right here. The wick there, here. And as you can see, the market goes down and bounces back right on this level, but you've got many wicks right here in this zone. This is why we're talking about zones, right? Price, supports, and resistance zones, okay? You can use either, when it actually we're going to say the same when drawing trend lines. You can use either wicks or closing prices. That's your choice, right? But don't mix it, okay? Never cut a candle. Don't use a closing price and then for the second impact you're going to use a wick. No, never mix, okay? For horizontal support and resistance level, you may want to use boxes like I did, because I mean, it's very rare that the market bounces back at the right tick above a resistance line, right? It can happen, but it's very rare. Most of the time, the market uses zones. This is where institutional traders piles up, trades and stuff like this, play with the market price. So I think using this, technique or method is very, very efficient. So now we're here. The market bounces back. Okay. You know that your next support is there. So your objective for this trade should be naturally around there. Okay. You go there, and here you can see that we have a breakout. And the market goes up. And the market, because there we have such a bullish momentum that the market doesn't even give. Normally, you have a pullback. When you have a breakout of a resistance level, you always have, I mean, not always, but most of the time you have a pullback because, I mean, the market has been capped for so long by a resistance. It has been tested many times by retail and institutional traders. So when there's a breakout, the market has the need to test the newly established support areas, right? So this is why most of the time you have a pullback. And actually, I can show it to you. Look, let me remove those. Let me put this one in red so you can see it. Look. So for example, if you take this this price swing right here, okay? So let's say we're here at the very bottom of it, okay? We have a bullish move, all right? So now you know that let me draw the shape as well. Object, shape. There we go. So you see, I've based my red line right here on the closing price of this last top. And I put my rectangle, including the wicks of that top. Okay? So now look, let's go back to the situation. The market bounces back up. Strong acceleration. Here, the resistance level is recognized another time. Okay? The market goes back down a little bit. Okay? To gain more momentum. And then we have a breakout here. Okay? A solid breakout. And here, we have a pullback, a double pullback actually, because we have this low here and the second one right there. And what happens on that level? This can be seen as a double bottom, continuation double bottom chart pattern formation actually. And here, once the market has bounced back and confirmed now that this previously resistance level is now seen as a support level to the markets, the market does what? Bounces back up. And where does it bounce back up? It goes back there. Look at this. So again, I'm taking the closing prices, including the week, and the market bounces back there. Another resistance level. What does the market do here? Goes back down. Where does it go back down? Look. It goes back down there on the last stop here. Goes back down here, another acceleration, another breakout of that level. Now the market goes there because this is the last resistance level right here, as you can see. You see, those things are not random, okay? This is technicals. The market goes there, bounce back down, so we have a pullback on that level, on that red line, and then this is the end of the bullish trend. So now the market is ready for another correction move, right? And the market goes back down, and so on and so on and so on. I'm not going to waste your time. I think you've understood the idea behind all this, but marking your markets provides you with so much comfort and helps you, building a solid roadmap for your trades. Okay? Because now let's say, okay, let's go back to the end of the chart. Now I know we are in a bullish trend, so this is hard to know where the next resistance level is going to be. Even on a daily chart, it's the highest point right there. So yeah, actually we are trading close to a resistance level, but we have another one right there above 122, for example. You see, so it helps you knowing where the market is maybe more likely to bounce back, where the market is more likely to stop its rally and things like this. We're going to move forwards with the rest of the session. And we're going to talk about trend lines. There's something I've briefly mentioned actually regarding resistance and support. Marking your charts using significant support and resistance areas helps you building a trading plan, helps you building a roadmap for your trades, right? So now the thing you want to do is, I don't know if you're a long-term investor, a mid-term trader, or short-term, very a scalper or swing traders or whatever. But anyway, always start on higher time frames. For example, this is a weekly chart. You see, we have the strong bullish move right there, and we know that the market is. I mean, there are some resistance level right there. So this could be a nice target. I mean, I'm not telling you to do it, of course, obviously, but I mean, these are the latest recognized tops on the weekly chart. It's a very long-term chart, right? So you always start on a higher time frame and then you narrow down your analysis like this. Okay, always. Markets goes with the fractals and stuff like this. So please do it the right way. Start high and then you narrow down with the time frames. All right, now we're going to move to trend lines, if you don't have any questions. So now I'm gonna be quick with this one. So a valid trend lines needs at least 2 touches at the very least, okay, to form a hypothesis, and 3 touches for stronger validations. Okay, some traders actually only use trend lines with 3 touches. Some others are less cautious, I would say, or likes risk a little bit more, have more risk appetite. 2 touches are enough for them. Okay, so I'm gonna let you define your investor profile right here, and choose the one you prefer for yourself. But the thing is, you need 2 touches at the very least, and 3 ones for confirmation or for a stronger validation. So now decide if you draw again wick to wick or closing price to closing price, and also never force a line that fights the natural structure. Let me show you how it goes. Actually, we're going to use the same example. I think we were on this one. So, for example, we said at the very beginning of this session that a bullish trend was characterized by higher highs and higher lows. Okay, now it's time to link those higher highs and higher lows right there. Okay, here we are. We have a good one, and we have 1, 2, 3, 4 touches. So this is a strong one. Now you can notice that the price is significantly higher than this trend line. So, I mean, and actually we can also duplicate it. Actually, we can even draw a channel. Let's see if we have something here. Maybe like that. No, we don't. No, we don't. Only the bottom one is valid because we have 1, 2, 3, 4 touches, but we don't have one here. So the upper one is not valid. Okay. So yeah, however, we can draw one there maybe. This is really interesting. As you can see that the market is currently trading inside a bullish channel. I've just linked the bottom altogether. So the market has been trading inside a bullish channel since the 11th of September. So the very short-term trend is bullish on Euro USD. Very recently, we have a new top close to 118.79, I would say 75. And here, what's happening right now is very interesting because this is a volatility spike provoked by the decision on rates from the FOMC, the Federal Reserve. So we expect a volatility spike actually when that kind of event happens, and that's funny how the markets went up so much. Like we have a six, almost a 70 pips spike, which is fair for an event like this. This is fair. And now you can see that the upper bound of the channel has played its part because it contains the markets lower. So now, of course, it can always happen that the market breaks that, upper bound of this bullish channel. But honestly, it's highly unlikely. Okay, maybe we can expect the market is gonna keep trading higher, but with less and less strength, and then maybe we're gonna have a pullback. Where can we have a pullback? We can have a pullback there, maybe, on the last top, like a zone that has previously been recognized as a resistance for the market, which now may be tested as a support one. We still have to wait for the closure of that current candle, right? We are on the hourly chart, so that can happen in 32 minutes now. You have marked your chart successfully once you've done this. Okay? So let me take another example. You want to draw trend lines. First of all, you identify the trend. Bullish, bearish, neutral. Okay, bullish trend is high highs and high lows. Bearish trend is lower highs and lower lows. Then you link them together to obtain some sort of, trend lines right there. We have a good one. And we have another one right here. So now, this is a rising wedge. I'm not going to bother you too much with the chart, the different chart patterns and stuff. This is going to be the topic of the next session. Actually, we're gonna dive further into those things. But anyway, now that I know that the market is trading between those bounds, I know where likely reversal or bounce back may happen. Let me move on forward. So yeah, trend line, simple rules. 2 touches indicating trend line. Okay, 3 touches validate trend line strength. Use wicks or close consistently. Okay, so never mix. This is the golden rule. Avoid forcing trend lines. Let the natural market structure guide where trend lines are placed. Avoid drawing lines that don't fit the price action. Don't force it. Just go with the flow. Never chase the market than you anyway. So never force things in technical analysis. It's easy to see things, but just try to be neutral, analyze, brutally, if I may say so, and that's it. And last but not least, trend lines identify a direction and support resistance. You see, we have this bullish channel. Let me remove those actually. We have this short-term bullish channel. These are dynamic support and resistances as well. If the market breaks this first horizontal green line, it's okay. I mean, there's another support right there. If it breaks it, it can always go back to the lower bound of the bullish channel. But if it breaks the channel, what does that mean? It means that the bullish trend is no longer valid. It doesn't necessarily mean that the market is going to reverse to the downside, but it means the market is going to retrace or at least consolidate laterally. That's it. Maybe the market is just gonna register a trading range for a while, and then it's gonna go back to the bullish trend. We never know, okay? But when the market closes outside of that channel, it means the bullish trend outside, sorry, of the lower bound of the channel. It means the bullish trend is no longer valid, right? This is all this is all it means. All right, now let's move on to Fibonacci tools, and we're going to start off with Fibonacci retracement. So this is a step-by-step guide to key retracement levels and signal confluence. Okay, so in an uptrend, you want to draw from low to high and reverse in downtrends, of course. Key levels are 38.2, 50%, and 61.8%. Okay, you've got more levels than that, but these are the most significant ones. Okay, and actually the 50% one is not even a Fibonacci retracement. It's just the half of a move of a price swing. That's it. But it's not part of the Fibonacci logic, mathematically speaking, if I may say so. So yeah, best entries happen when a Fibonacci level confluences with support and resistance or a trend line. What I just said is very important. Okay, a Fibonacci retracement in itself is already a support area or a resistance area. Okay, but if you mix it with support or resistance areas or a trend line, then you've got a double or a triple support or resistance, which increases the likelihood of your scenario, right? Purpose of Fibonacci retracement is to help identify potential pullbacks levels in trading markets for informed trading decision. Confluence with support and resistance, stronger signals appear when Fibonacci levels align with support, resistance, or trend line. Fibonacci expansion. So, okay, Fibonacci retracement. I'm gonna switch back to the platform and show you how you use it afterwards. But let me go through this first. Fibonacci retracement are used to identify pullbacks, right? Bullish or bearish pullbacks. Fibonacci expansions are here to help you identify the next price swing. But first, let me read those. Common Fibonacci expansion targets 100%, of course, 127.2% and 161.8% extensions used by traders. Align expansion with support resistance, set realistic price objectives by matching expansion levels with nearby support or resistance zones. Again, it can happen that a Fibonacci level doesn't mix with any already recognized support or resistance level. It doesn't mean that this area is invalid, but it gives you more confidence if it's the case, right? Purpose of expansion levels, I've just said it, potential price targets beyond the current trend range for better forecasting. Okay, let me switch back to the platform. Let's say we are here. You know the market is moving higher. Do you remember this resistance area? Right there. Here, here. So you've played this price swing up to here. Okay. Now you know the market may be up for a correction. This first candle, okay, that opens there and closes here, gives you the tone. You witness a strong bearish reaction on that level, which is a resistance level as recognized here. And as you can see, the next candle confirms it because here we have a doji, here we have another red candle, another red candle. So you know a market correction may happen here. Okay. What you don't know is until which point you're going to use support levels. So you have a support right here. Okay. You have another one right there. And then you have maybe another one right here. And the last one is, of course, this one. Okay. So now you're gonna mix it with Fibonacci and 79. And I advise you to do the same in your MT5 platform because by default, those values are not there. As you can see, this retracement level has already played its part right there on the first price swing. Okay. Bounces back up, breakouts, the market goes straight down, and the market goes below the 50% zone. This is an area below the 50% zone when you're buying the market. This is becoming very interesting. And we see that we notice a strong reaction around that cluster, okay, of support, 61.8, 70.3, and 79. And actually, the 79 level is also been tested on another price ring right there. Once the 38.2% level has been reached, chances that the market is going to go to 50 are quite good. It happens more that the market goes to 38.2 and then to 50 than just bounces back from the 38.2. This is what I mean, okay? The 50% level is not a Fibonacci number, as I said a bit earlier, sorry. But it's just the half of a price swing, and it's the retracement that is the most recognized by the market. This is the most used. And 61.8 refers to the golden number. the golden ratio. So this one is also very important. But I would say, in my experience, I would say this cluster of all those three ones between 61.8, 70.3, and 79, those ones are very important. Very, very important when we talk about retracement, at least. So again, you have a price swing right there. And where does the market stops? We have a correction move here, and the market stops right there on the 70.3 level. I mean, this is not magic, but this is very impressive, to be honest. And there we go. We have another price acceleration, and so on and so on and so on. So now you can do it on a smaller scale as well. All right. So let's say you take this price swing up to here, and you can see that the market went up to the 38.2, but bounces back from the 50% level. And what's happening now is very interesting, because here we have a big price swing. Actually, let me zoom in so we can actually see. So the market bounces back up and then retrace 50%, actually 71.8%. Very interesting. Take this one up till here. And we can see that the market went up to the high bound of the bullish channel, and we have a very slow retracement to 33.6%. This is very, very little. A lot of volatility right there, actually. So this is very, very interesting. It means that the momentum, the bullish momentum, is very, very strong, and that investors, buyers, are either numerous enough or powerful enough to offset the strength from the sellers. Okay. And I mean, sellers have literally no chance in that price swing. We can see that buyers are clearly in control of it. Now, how do we use expansions? Expansions, so you see, retracement are meant to know where the market is likely to bounce back in the case of a bullish trend, right? When you have a price swing and you're looking for a retracement move. Expansion is the other thing. Expansion is when you have a price swing, you have a correction, and then you have a bounce back, and you want to know where the market is likely to go. Where is the next resistance level? Like, for example, the market here goes up, retraces, and then once it bounces back, you want to know where's going to be the next resistance level. This is where you're going to use Fibonacci expansion. All right. So first, you take the first level of the price swing from the bottom to the top in that case, and then you take the whole correction move. So actually, look, I've taken into consideration the whole price swing and then the whole retracement move. And okay, this is important. Do you remember when I said to you that when you place support and resistances and the trend lines, you may use either wicks or closing prices, but don't mix? For Fibonacci tools, it's different. It's only wicks. That's it. Okay, you want to go to the extreme prices, right? So here, the whole price swing and the whole retracement. Let me put a support level right there. And as you can see, if you were to recognize that bounce back level, you know that the market has shown some bullish intention here, and you play this bullish move, but you don't know where the next resistance may be. Here you go. You have the 100% level right there. And guess what? We've reached it. I've put those two ones, 100 and 161.8. You can add as many as you want. You have many Fibonacci expansion levels, but me, for analysis purposes, I've noticed that those ones are very, accurate and very used. So there you go. It gives you like an idea of the target. And actually, this is especially true for the current context that we have right here, because here, look, the market is trending higher, but you don't have any. Let me remove this one. You don't have any idea where you have no areas where that the market has already recognized, unless you go to higher time frames like weekly or stuff like this. And actually, the support that we have, the only support that we have this one right there. And actually, it's more of a zone, as we said. Well, fair enough. So this is the only areas that we have. And you have to go to much higher time frames. Like this is a weekly chart right here. Okay. Now let's go back to H1. Let's say you're here. Okay. And you want to know where the next target may be. So insert object Fibonacci expansion. And here you're gonna take the price swing just like we did. Uh, sorry, this way. Actually, this way. And well, we don't have the bounce back right there. Actually, can we do it from this point? Let me try this. Okay. And then we take this one. No. Okay, the next support level, the next resistance level is right there. Okay, so now let's take this one. And now it's hard to tell you where is going to be the next resistance level because the retracement, I mean, we don't know with this candle. Look at the size of that candle. We don't know where this candle is gonna end up closing. But if it closed there, let's say it closes around the lower bound of the charts, um, sorry, of the bullish channel right here. Let's say it goes to here, then you have 100% here, and you have 161% very close to the weekly resistance area. This gives you convergence, right? This is really important. And don't take my word for it because we don't know where the end of the corrective move is going to be. Maybe the market is going to go down up there, to test this level that we have left here. Maybe, you never know. Maybe it's going to go up from there. You never know. But this is how you use expansions. Okay. All right. I think I've been to the end of what I wanted to tell you. Let me go back to the presentation. Yeah. Here's the recap mini trade plan checklist. So first, you identify the trend. Trend is high highs, high lows, lower highs, lower lows. That's it. Then you mark, I mean, you do it and you do it on several time frames. Okay. You start with higher time frames, weekly, daily, H4, and then you move on, you narrow down to H1, M15, M5, or M1. Okay. Then you mark your chart, support, resistance, highs, lows, round numbers, stuff like this. Okay. Then trend lines. Again, I'm not going too deep with this one because we're going to talk way more about it in 2 weeks' time. We're going to talk especially about the chart pattern recognitions and how to trade them and stuff. And then you may use Fibonacci to build your trading plan. Okay, let's say, okay, I've noticed there's a support there. Once we bounce back up, Fibonacci tells me that the next resistance may be there, blah, 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 and so on and so on. And then you manage your risk. Again, we're going to talk, I'm going to tell you, I think it's in maybe 4 weeks, 4 weeks or 6 weeks that we're going to do the session on risk management. But actually, the aim of this 7-part live webinar session is to make you able to pick your markets, analyze them, build a trading plan, like where to enter, when to close a winning position, when to close a losing position, how much, to invest, how to do your position sizing and stuff like this. So at the end of it, you'll be able to do all that, right? This is why we're going step by step, little by little, right? Risk and entry. Okay. Okay. I'm just gonna give you like while I provide you with a summary of key technical analysis tools, the key points of what we just said. I'm gonna give you like 1 or 2 minutes to maybe write the questions you may have, and afterwards we're gonna wrap this up. I know it's not always easy to think of a question when the time comes, but please bear in mind if you don't think of any at the moment, it's not. I mean, it's all right. You always have the ability to reach me directly through GMG Markets, either by email or phone. I'll be there for you if you want to know more about Global Markets Group products and services. If you want to know more about how to open an account, a demo account, to know more about withdrawal deposits, or if you just want to talk about the markets or technical analysis, I am your guy. Please feel free to reach me anytime you like. Many of them have done it before already after the first two sessions. But yeah, please bear in mind, I will be there for you. Okay. All right, I don't think we have any questions. So this webinar has been recorded anyway. It's going to be published on our YouTube channel in the next few days, if I'm not mistaken. Meanwhile, please, I know I've said it already, but I'm going to say it again. Oh, actually, I have someone raising its hand. Now I see. Angad is asking us about trading book suggestions which can help beginners. This is the first question. And second question is with algo trading coming in, trading using softwares and computers, will technical analysis become less accurate? Because technical analysis is about analyzing market psychology, and with fewer human participants, there will lesser impact of crowd psychology. Okay. Um, that's interesting. That's interesting. So first of all, Angad, let me apologize. I know you've asked for the book suggestion. I think it was on the last session, if I'm not mistaken, 2 weeks ago, and I didn't come back to you. I'm gonna come back to you by email. I have your email right now. We've been talking a little bit already, so I'm gonna come back to you tomorrow about it. Okay. Please feel free to send me an email if I forget, but I'm not gonna forget. Actually, I'm gonna take a note of it. So yeah, I'm gonna do that for you. And then algo trading. I mean, okay, this is an interesting question. So the thing is, now we're talking about algo trading and stuff because we have a lot of AI into the market, and it becomes more and more easy to for everyone to build its own expert advisor and algorithm and stuff like this. Okay, before AI, you needed some strong, coding skills and stuff like this. But the truth is markets have been using algorithm on an institutional point of view for years. I'm not going to say decades, but at least a solid 15 years, the very least. Okay, this is why cons are made of, in on trading floors and stuff like that. They designs algorithm because the thing is, institutional traders, um, they cannot go in and go out the markets like retail traders. Okay, they play with such big amounts that they cannot, open a position in one go. Okay, it would lead to several slippages and the market will move. Okay, and they don't want that, so they have to build up a bullish position or a bearish short position and stuff like this. So this is why they had to design some algorithm, to detect some interesting entry points and stuff like this. I'm not gonna go too much into the details, but long story short, and get since the markets has been, I mean, the industry has been using algorithm for solid 15 years, if not more, and the markets are still there, and it's still doable to make some profit out of it on the retail, perspective. I don't think it's going to change anything. Okay, actually, and also algorithm are designed by mathematicians, from a mathematical perspective and technical perspective as well. Okay. Technical indicators are derived from the price itself as well. So they include one another, kind of. And so I think actually, the more you're going to have market participant using the same indicator or the same algorithm, and the more accurate your prediction will be, if you see what I mean. So no, I don't think it's going to derail the market, to be honest. Okay, have you got a WhatsApp group? Actually, I do. I mean, no, we don't have a WhatsApp group, but I am reachable on WhatsApp to talk about this. I mean, GMG Global Markets Group is reachable. We have a WhatsApp. We don't have a WhatsApp group, but actually, that's a good idea. Maybe we can create one. That's a very good idea, actually. I'm taking note of it, because it's always a pleasure for me to exchange with, market passionate people. I love that. It's always interesting and enriching to have different point of view, different ways of doing things and stuff like this. So yeah. Do you offer prop firm trading? No, unfortunately, we do not. We only provide CFDs on an execution only basis. That's it. We don't do prop trading or stuff like this, unfortunately. Okay. Now, I can see we don't have any more questions at the moment, so I'm just going to wrap this up. Thank you. Thanks to every one of you for being here tonight. Please, please, please feel free, just like Engad, please feel free to reach out to me anytime by email, phone, um, WhatsApp message, or whatever. And actually, sorry, I didn't see your last question. If you plan on creating a WhatsApp group, how can we join? I'll let you know. I have your contact details. Once we set up that thing, we will come to each and every one of you. We will want some people to participate to that group, so you will know. We will send you an email. We will call you. We will do something. So don't worry about it. I'm on it, and I'm gonna take this ID to the upper management tomorrow. I'm sure they're gonna love it actually. So yeah, I'll let you know. I'll let you all know about that. Thank you all for joining me for this session tonight. Please feel free to reach out to me any means necessary, emails, phone, or anything like this. I'll be there for you. And meanwhile, have a good trading, stay safe, and have a good night. Thank you.